The broadcast is now starting. All attendees are in listen-only mode.
All right, welcome everybody. Thank you for taking time today to join us for this IAMS Wealth Management webinar. I'm Charles Heuring here. I kind of run the day-to-day operations of IAMS Wealth Management. And today I have the pleasure of actually being joined by Chris Bush from First Trust, one of the asset managers on our platform. Can you hear us okay, Chris?
I can.
Excellent. Well, thank you again, Chris, for taking time. I know this is going to be a great webinar for advisors and maybe people considering IAMS Wealth Management alike. Before I do kind of roll into the topic today, I just kind of want to talk about a high-level overview of IAMS and IAMS Wealth Management in general, just because we do know there's a diverse audience watching. Many of you are already advisors with us, already know the First Trust story, and are here to get maybe a tune-up on some of the strategies. I know some of you attending might be just considering adding assets under management to your business, what that might entail. IAMS Wealth Management really came to be in 2016 with an advisor first mentality in mind. And what I mean by that is we are a full service back office for investment advisors that might do annuity business, life insurance business, Medicare business. We realize that you're trying to do tons of different things for your end client. And if you're spending a lot of time doing back office work, managing each account down to the asset level, going out there, filling out paperwork, doing all these various necessary tasks that are just time consuming, you're not necessarily reaching your full potential. So we bring a lot of that on board as an RIA here. So I'll go to just our one slide quick before I get to the First Trust presentation. But this is our goal really for all of our advisors through us. If you're out there doing asset management already and are looking for maybe a new partner that can make you a little bit more efficient, or maybe help you from a payout standpoint, or give you more platform options, we're a good home for you. If you're someone who is maybe not offering any securities business now and are wondering why it might be a good choice to add to your business, these are really the three big key components that a lot of our newer advisors see added to their business when they add assets under management. Going down the list here, increasing revenue, and that comes in multiple different ways. First and foremost, obviously, as a fiduciary advisor, you're managing investment accounts, you're charging an ongoing fee. That's going to be a monthly revenue that kind of annuitizes your business. So it's going to be a nice complement to maybe those annuity commissions you're already receiving. But at the same time, it's going to allow you to get in front of a more diverse group of people, likely a higher net worth group of people. And when you're doing that, it's going to help all lines of your business. So you're seeing that revenue growth as well. Going down to our second bullet point, we see a lot of improved client retention from advisors who have the managed money securities capability, just because you become a full service solution for your client. They're not going to need to go elsewhere to get a different service. You're not going to put your relationship with them at risk because there's a second voice talking to them about their assets. And that kind of bleeds nicely right into the third point there. Just strengthen client relationships. You are that full service, complete family office for your clients. You're viewed differently by them. You're a fiduciary when you're with IAMS Wealth Management, meaning you are obligated to act in their best interests. Not that there's many advisors out there that wake up every day with the intention of doing otherwise, but when you're with IAMS Wealth Management, that's a badge you can wear, knowing that each and every day you're obligated to act in your client's best interests. And they understand that now. The word fiduciary is out there. More and more people are starting to get involved with the whole concept of knowing that they want to work with a fiduciary. By being with IAMS Wealth Management, you have that capability. So getting into kind of the First Trust component of it, IAMS Wealth Management, we came to be in 2017. That's when we opened up for business. We're up to 42 advisors now. At the time of recording this, we're just about at 70 million of assets under advisement. And that is through investment advisors, just like many of you listening who are either just starting this or doing this maybe at a small scale, looking to capitalize and increase your growth. We wouldn't be able to see the growth that we've already seen without key partners like First Trust. And First Trust is one of the managers on our platform that I alluded to that is helping us in a lot of different ways, not only from an asset management solution, which you're going to hear about today from Chris, but they do a lot from a market research standpoint with their Monday morning outlook that our advisors get on a weekly basis. They actually have practice management, coaching programs that kind of help you grow your business line, with First Trust. And just to give you one final plug before I turn the phone over to Chris here, the biggest reason I appreciate our relationship with First Trust is because they really do market for you, the end advisor. They're not out there competing with you on the front lines trying to gain clients direct. They want to grow your business because that grows their business. And for those of you that know the IAMS family, we're all about relationships. So it's nice to work with a group like First Trust who really, shares that same mentality. So as I transfer this slide over here to the First Trust kind of slide, I will then give you the floor, Chris. We're looking forward to hearing from you.
Awesome. Thank you, Charles, for the introduction. If we could start on slide 2. So just a little background on me. I work in our quantitative equity group. So anything that touches anything to do with smart beta or factor-based ETF is where I live. I've been at First Trust since 2005. I have 14 years experience. Our quant group is 10 members, and we've been doing quant since the mid 90s. So we have 20 plus years experience. First Trust, we've been around since 1991. We have about 135 billion under management today. If we transition to slide 3, though, slide 4, a little bit of history about us. We've really been in the smart beta ETF game since 2007 with our AlphaX lineup. So we've been here a long time. We've passed 80 billion in AUM in ETF assets. But over the last couple of years, really we've seen a lot of demand for model portfolios and putting some different packages together. So that's what I want to focus on today. Topics kind of have an outline. First, I want to talk a little bit about the process and the people that goes into building these models. As I walk through this, I'll also share some of our current positioning, what we're seeing from an economic standpoint and a strategist standpoint today. And then lastly, I'll get into some of the different models that we offer. We have a number of different models that should meet most investors' criteria. One model will fit under there. So if we transition to slide 7, there's really 4 key top-level points when we look at our models that we build. It is first off, it's a very collaborative process between a lot of different people. So we have a lot of meetings. There is quants like me that are more based on building models. There's a number of fundamental managers. There's bottom up and there's top down, just meaning that we have more stock pickers, more model builders at the bottom up, but we also have our economics team led by Brian Westbury. And then we have our strategist team led by Bob Carey that look more at the big picture. So that's really the first point. We also like to build a strategic core and satellite allocation. So that falls a lot under our top-down and bottom-up as well. Maybe there's some subsectors that we find attractive or industries, whether it's biotech or banks or another industry. We can go overweight based on the collective thought. Another main differentiator about our models is we try to gain alpha through asset allocation, but also we use a lot of our factor-based ETFs in these models. So it's really a 1-2 punch of trying to top-down allocate, but then also through different factors such as value and momentum and quality, low vol factors like that. We try to add value on top of the traditional asset allocation. And lastly, another key differentiator with our models is they're very transparent and explainable. So every quarter, a couple days before the end of the quarter, we release our model updates, and then we also have a lot of commentary that goes along with the models. It says exactly why are we positioned this way, and then it shows all the model changes. So it's very, very transparent, and the First Trust, we offer different access to our different PMs and other members to go over why we're positioned the way we are. So transitioning to slide 9, this is a number of different committees that we have. So you'll see we have the main investment committee that makes the final decisions on the models, but we also have alt subcommittee, a fixed income subcommittee, and an equity subcommittee. I'm on the equity subcommittee, so our job is to get together, give our views of where we think we should position for the next quarter. Same with the fixed income subcommittee and the alternative subcommittee, and provide, we think this is the current positioning that we should have on the model. So that's more the bottom up. The macro teams, Brian Westbury's group, Bob Carey's group, they're more the top down, give us the 1,000-foot view from above from the economy. And their group, how the process works is we're moving into where we'll start to think about the year-end changes in the model. So in the next week or two, we'll have a meeting with Brian Westbury and Bob Carey, and they'll share their top-down views, and then we'll start forming our bottom-up views. And that will lead to a few meetings by each of the different subcommittees, and then ultimately a couple meetings near the end of the quarter for our investment committee to decide on the changes. So as you see, there's over 20 investment professionals that make these decisions from very different backgrounds. Like I was saying, I'll share some of my viewpoints as we move through this, and mine is definitely more a quantitative background on where we should be, more factor driven, whereas others on our subcommittee are more fundamentally driven stock pickers. So it's a really good mix. And then I'd say about our fixed income teams, we are the largest actively managed ETF provider, actually. And a lot of the people on our subcommittees are also portfolio managers. So we're getting, we have a MBS team, we have a leveraged loan team, a municipals team that all brings their thought capital to the table to help inform our views. And to date, so some other background, model changes are initiated quarterly. We do reserve the right if there's a major market shift to make monthly changes. But these models do tend to be more strategic in nature. So, we're looking at least 6 to 12 months. We're not going to make a ton of tactical decisions unless there's a really great opportunity in the market. So they're more long-term buy and hold models. And then moving on to slide 10, you can kind of see some of the stuff we already talked about. Some of the key drivers of our disciplined approach are macro policy drivers from the top, asset level analysis like I was talking about with the subcommittees. And another point I would like to make is that we have a risk manager on our investment committee. So he's going to look at our models. He's going to look at the active risk on the models. He's going to look at, the ex-ante, the betas, like what are we projecting out for the different risk tolerances of the different models, and where do they fit into not just the alpha generation, but also is this risk active and absolute risk within our bands, and all this reports back to the investment committee. And then turning to slide 11, so some of the things our macro team and market strategies we'll look at is obviously, some of you probably read Brian Westbury, so anything that has to do with tariffs or forecasted macro growth in the economy. As we look at positioning right now, I'm curious where Brian's going. We'll have that meeting in the next week. But, from my vantage point, we actually think the economy looks pretty good right now. We expect continued moderate growth, maybe not, super robust growth, but we think that the economy has still a lot of legs to it. One interesting data point that we've been watching closely is the ISM manufacturers survey. Obviously, most of you are probably aware that there's been 3 months in a row of pretty bad data for the ISM survey. But one thing that's pretty interesting there is that you got to remember that it's a survey, right? So these purchasing managers see, talk about tariffs, slowing economy. China's going to, end this U.S. run. So when you see headlines like that, obviously as a purchasing manager, your sentiment changes. But if you look at the industrial production numbers, they've actually held up a lot better. Now, this most recent industrial production number was a little bit weaker, and that was mainly due to the GM strike. But what you've seen is you've seen kind of a bottoming of potentially the industrial production, and the ISM has actually fallen a lot more, well below 50 for 3 months in a row, showing contraction. But what we think there is that we think the ISM manufacturing number can, rise back up, and that's usually very, very good for equities. And obviously that's a headline risk right now, but we think that's a little bit overdone. And then obviously the other part of it is the consumer remains really strong. So I'm not Brian Westbury at all, but I think that's a couple interesting data points right there. And then from the market strategist team, the top-down view where we're looking at different sectors that look good or different geographies around the world, where are earnings going? Some interesting things there, I would say, is currently, if you look at EPS growth for 2019, it's actually pretty non-existent. When you look at the S&P 500, estimates have come down a little bit. But is the economy flagging? Not really. There's a couple key drivers there that are affecting growth. For one, energy and semiconductors and semiconductor equipment have been a big drag on S&P 500 earnings. But the other more interesting fact is that if you look at median growth for EPS, this year it's around 5% versus 0% for the broad index. And what's driving us there is there's really some large names that have maybe a little bit of a margin hit, like an Apple, that are really skewing down the earnings estimates in some of these larger hardware tech names. So, we expect, one, those semiconductors, the cycle's already bottomed, that's turning, so earnings to be better there. Two, energy, a lot of the negative news of oil coming down in these most recent quarters, the year-over-year comparables is going to be easy. And then three, if you look at more a median earnings growth basis, earnings look a lot stronger when you go down in the cap range a little bit, which is really interesting, right? Because when you look at the market year to date and over the last 5 years, you've had the largest stocks in the market really lead the market. So if you look at year to date, for example, Apple's up 70% this year. It's a $1.3 trillion market cap. Microsoft's up 48%. So we're living in a little bit of a weird time when, Apple, they have this switch to services that the markets really liked it, more sticky revenue. But if you look at their year-over-year revenue growth, it's actually negative 2%. But when you look a little bit deeper, earnings growth still looks pretty good. So overall, from a top-down perspective, we're pretty bullish on the markets moving forward, despite a decent run-up year to date. And the other thing I would point out is companies are generating a lot of cash. So on a PE basis, the market's a little bit expensive relative to history. But if you look at like free cash generation, the market's actually a little bit below where it's traded traditionally. So companies are just have good margins right now, and they're generating a lot of cash. So from a top-down perspective, we think the market looks pretty strong. Moving on to slide 12, this kind of puts it all together again, what I've been talking about, but the different subcommittees, like I was saying, report up to the main investment committee and make these these quarterly changes. So slide 13 is our fixed income current positioning views. I'll skip over those a little bit just because I'm not as much a fixed income guy. But in our models today, we're positioned to be short duration a little bit, which, with the 10 years low as it is, we think that's a prudent move. And then we're also pretty moving more to neutral on credit quality, right? So the spreads are not huge right now, so the risk there is maybe not worth it. We have a few pockets of opportunities. But more, I want to spend some more time on our equity allocation views. Today, that's where I live, was more an equity guy. So like I was saying at the top down, we still are very bullish on the economy, mainly driven by a strong consumer. We have healthy balance sheets. We have an improved regulatory environment in the U.S. So from a top-down view, our subcommittees, also view the same as our top-down strategists. But as we look inter-asset classes, what looks attractive to us, small and mid-cap equities, or even smaller large caps in a non-market cap weighted benchmark, look attractive. Like I was saying, the median earnings growth of the S&P 500 is closer to 5% this year versus 0% at a market cap weighted basis. If you look at the Russell 2000, it still hasn't gotten back to last year's highs in the market. So what's really interesting to me is that small caps, which are less affected by tariffs, right, have actually underperformed large caps over the last year and a lot of the last 5 years. So if you look at the spread between small and mid caps versus large caps, it continues to widen. Now, it's been a hard run, right? Because for most investors, you'll open up your 401k or your different investments, and for most of the last 5 years, what has been the trade that you have wanted? It's just put your money in the S&P 500 because the biggest names have won. But if we look since the end of August, we've actually started to see a shift in the market to more of a smaller size stocks, like small caps and mid caps, and value stocks actually working, which has not been the case over a lot of the last 5 years. And some of that, I think, is driven by when we talked about a lot of economists are seeing some of the data bottoming and reversing to stronger economic data. And when you look at valuation spreads, on the top 10 stocks versus, smaller and mid and even smaller large caps, the spread has gotten pretty extreme. And I'll get into that a little bit more when I shift to talking about factors in a minute. From a sector basis, we still like technology. Despite technology running really well, I think there's just some really good secular headwinds, especially if you look at software as a service or software names. If you look at the amount of data that's getting collected, and then firms that really know how to use data to monetize it to build advanced models, there's a lot of a competitive advantage that you can gain over other firms. I think you've seen that with some of the run-ups that big tech has had. So we like technology just as a strong secular sector to bet on. Another sector we like that's out of favor is healthcare. Interesting enough, healthcare has actually posted some of the strongest earnings growth. I believe it was the strongest growth last quarter out of any S&P 500 sector. Obviously, there is an overhang on the sector on the single payer issue. Will we get Medicare for all? However, we do believe a lot of that is already pricing in to the market there, and we think there's definitely from a bottom-up perspective, if you buy a diversified healthcare basket, there could be some opportunities there. We are also overweight the consumer. The U.S. consumer continues to remain strong. If you think about tariffs, maybe there's some caution with corporate spending, whereas the consumer, he can spend regardless, and they continue to have strong retail numbers. So International versus U.S. in our models right now, we're currently underweight international versus U.S. Our view there is that the U.S. is just stronger growth, that international, we have less regulation, and in fact, while tariffs do hurt the U.S., they actually have a much bigger impact on EM nations or DM nations that or even Europe that has more to lose in export. One thing I note is the U.S. is more expensive. However, you also have to look at it through a sector view. So if you look at the MSCI EFA index, very interesting that the tech sector weight over there is only 7.5%, versus the U.S. is plus 20%. And then if you put comm services in there with Facebook and Google, which make up 5% of that sector, you're pushing 30% of the U.S. market cap now is in the tech sector, which deserves a premium multiple to the market. So you will read a lot that international is historically cheap versus the U.S., but you also have to look at it from a sector relative standpoint, and it's obvious that we have a lot of great tech assets here in the U.S. But Charles, if you could, I just want to talk a little bit before I get to the actual models and what models we provide. Could we flip to the factor piece that I sent over? Because I kind of want to talk about what we've seen in the last year in the market from maybe a little bit different vantage point, and then kind of talk about what else we see going forward from a factor perspective, because that is also a big piece of what we do. Is not just the asset allocation part, but also buying, putting smart beta ETFs into our models to try to gain alpha there as well. Cool, perfect. All right, it's on the screen. So this is a little bit different way to look at the market. So there's 6 factors that we talk a lot about at First Trust that we think are rewarded factors. And all we mean by rewarded factor is if we look at the long term, these have provided a persistent return or a similar return to the market with less risk over time than the market. So these 6 factors are low volatility, dividend yield, quality, value, small size, and momentum. And we have a number of ETFs in our models that target these different factors. But I think what's helpful, if we look at the last year, even 5 years, what has been the drivers of the market? There's really 2 big drivers if we look at the market, right? So there's been a great secular growth story in these mega cap tech names that have been able to outgrow the market. They're a little bit higher beta than the market, but they've been able to win by growing their market share. And that's really the FANG trade that we've seen over the last 5 years. So the biggest market cap names have won. And then on the other flip side, a completely separate trade, what we've seen is the defensive expensive really works. So this is the low volatility factor. If you look at the low volatility factor, it has continued to outperform. If you look at the last 12 months, it is by far the best factor, which is really interesting, right? Because if you look at the market and you would tell me that the market's up 24, 25% this year, would you think that the low volatility factor is leading year to date? No, it's not usually, that would not usually be the case. But what has happened, there's a couple things, right? We've had lower rates, which benefits the low volatility factor, and we've also had this very cautious stance where we have economic growth, but it's pretty weak. And then there's always been some geopolitical risk, out there for investors that makes them a little skittish. They want to stay in equities, right? But there's tariffs, there's Brexit, there's slowing global economy that has pushed investors to some of these safer trades. So, and you can see it if you look at some of the big low volatility ETFs the USMV, the SPLV. You've seen massive flows into those funds year to date. We even see it with FBD, our First Trust Value Line Dividend Fund. I believe it is our largest ETF now, and that's a low vol dividend trade. So it's just very interesting that we have such a big upmarket, but these are the two trades that have worked, the secular growth trade and this low volatility stock. But if we switch to slide 2, or the second page on this report, what's interesting to me, and, this is some of the analysis I use when as a quant, really, so if you look at these different figures, figure 3 stands out to me. So if we look at the low volatility factor now, it is trading at the 100th percentile of most expensiveness it has since 2005. So if you look here, that blue bar on chart 3, the factor is trading at about 23 times earnings. So well above the S&P that's around 17, 18 times earnings. And what else is really interesting about that is it's not the low volatility factor. It does not have the growth rates of other factors. So yes, momentum is expensive. You can see that it's actually more expensive, but the growth rates of momentum factor are a lot stronger. So what does that give us from a positioning standpoint on our models? We have a more cyclical bent. We have a little bit higher beta bent currently in our models because of this. The other thing I'd point out is the momentum minus, in figure 4, the momentum minus value PE spread is also near historical highs. It's actually come in, so since the end of August, we've actually seen a rotation in the market to more value in small size stocks, like I was saying. And what's interesting here is, there's a lot of pundits out there saying, is this the great switch to value from momentum, or sorry, from low vol, from these quality trades? And the answer is we don't know for sure, right? Like, on the one hand, quality and low vol look attractive today for a lot of investors. Why? Because we don't have this robust growth in the economy. So it pushes a lot of investors to stay invested in those factors. And what we'll say from our model perspective is, hey, we don't know the future, but what we do know is these 6 factors tend to work. So what we want to do is we want to diversify across some of these factors. So what we've done over the last year in our models is we've shifted a little bit more towards the low vol and quality factors, but we've maintained, weight still to some of these other factors that have been unloved. And I think this month we're benefiting finally from a cyclical recovery. We're benefiting from value coming back. And if you look at value, it's dirt cheap versus the other factors. It's just a question of when will it recover. And that's why we always pair these factors together, because we know that they're cyclical. We believe the data that they're going to work again. So that's where we stand on that, and we think that they're long-term. We're going to generate alpha from diversifying across these factors. So that's just a quick factor update. That's more of my lens. When we do these models, there's obviously a bunch of fundamental guys in the team that also bring their views. But then, Charles, if we could flip back to the models presentation. A lot of the rest of the slide decks that you guys can look at is our different models that we offer at First Trust. So we have, from a really high level, we have the strategic models, which have different risk tolerances from aggressive all the way to conservative. There's a number of different models, and that is just going to take you from aggressive growth to conservative, and there's going to be a different bucket for every investor. So obviously the top aggressive growth model is going to have the most weight in equities, and it's going to tick down based on your client's needs. The focus models, those ones are just focused on a specific asset class. So we have an all equity model. If you just want equities, you have an international equity. For fixed income, we have high income models. We have limited duration. Fixed income models are more safer. But we have an alts model. So basically, we have a flavor for whatever type of investor they might need. And our investment committees, our thoughts goes into each of these models and appropriately select funds based on the different risk tolerances. So with that, that's all the prepared remarks I had, but I am more than happy to take any potential questions.
Yeah, and I know we did get some questions trickling in, throughout. So this has been great. It's good to get that, back end insight to a little bit of the thought behind, what goes into these models, because that is what our advisors lean on. So if you're out there, I know some of our existing advisors are listening, and some people that are maybe considering bringing this on are listening. You can see that our mantra for our advisors that we always say is that we don't expect advisors to come to IAMS Wealth Management and be an asset manager per se. And you obviously want to know the models and know the managers and help allocate accounts. But really, we want you to be able to focus on being an asset gatherer and meeting with those clients, building those relationships and expanding your own business and leaning on groups like First Trust. And you can see in the last 25 minutes the high level of detail they go through with all the investment decisions that they make at a high level, low level, sector-based, market-based. Those are the type of people that you can lean on when you're talking to your client saying, hey, I'm meeting with you, I'm meeting with all my other clients, but I utilize a group like First Trust who actually has, a committee of 20 plus individuals who help make a lot of the investment decisions based off the models that we're getting you into. So it's a really, really efficient way for, I think, advisors to find a systematized process for how they want to start a book of business, grow that, and then maintain it. And like he was mentioning, with very strategic risk models that you're seeing on the right-hand side of the screen, as your clients slowly maybe move down in risk tolerance as time goes on, there's nothing wrong with going right from moderate growth down to balanced growth, down to conservative growth as that time goes on for that client relationship. And within that bucket of assets that Chris mentioned, there is a blend of these various strategies involved. So it's not like your clients are getting plugged into a balanced growth and that's just, one entity that they're invested in. There's all the underlying investments that are getting rebalanced on that quarterly basis that he mentioned. You as the advisor are not having to do any of that heavy lifting. That's what you're using a group like First Trust, who has the time and expertise to focus on that, to do what they do best, and that's make those management decisions. So I did just want to make mention of that. One question that did come in that an advisor asked is, and I think you touched on it a little bit, but you do have more of a strategic focus, but on a quarterly basis you make gradual shifts. But then what is your kind of policy for any of those intermediate disruptions in the market that might arise? Do you have kind of a protocol? Do you have, I guess, flash meetings when various things might spike that would cause the need for radical portfolio change, or how does that kind of work at First Trust?
That's a great question. So we do meet monthly in between the quarters, and it could be honestly any time in between. And really what we're looking for is a deterioration in the hard data. If we were going to make let's just say the market sold off hard, like 4Q18 last year, we considered making a change, but what we looked at was the hard economic data, and it wasn't showing signs of recession, even though the market was flashing recession. So there will definitely probably come a point in time where we do make an intra-quarter change, but it will be driven entirely on the underlying data of the economy.
Perfect. No, that's a great answer. And kind of to that point, I think you mentioned it earlier too, is that every decision that goes on in these portfolios really is transparent. I mean, they send out, if you're not on their email list and you want to be, definitely reach out to me and I can help get you added. But they do send out all their emails, whether it's for performance numbers or allocation changes, rationale behind that. They keep you, the advisor, informed, so that way you can be proactive with clients who might be getting antsy or getting curious on what's happening and why. You're already armed with all that information. You can get it via the email. You have login access to their website where you can get access to any of the materials that you might need, whether it's portfolio, holdings, rationale behind the strategies. If you want to look at some sales literature, you have access to all that. So they are a great resource for you to lean on to that extent as well. With that, actually, that was the main question. I think the rest of them you actually pretty well knocked out of the park with just the general discussion we were having. So if that's all you really have, I don't want to take any extra minutes from anybody who's taken time already to join us. I will say I will be following up individually. So if you have any follow-up questions and you don't want to ask it in a setting like this, totally understandable, but I'll follow up with you. And if you have any questions on how you might start to incorporate this, how you might want to shift to using first trust style strategy in your clients' portfolios, more than happy to have that discussion. My team is as well. So thank you all for taking time out of your morning to join us. Thank you again, Chris, for joining us. We appreciate you making the time to be with us today.
Thanks for having us on.
Awesome. Well, have a great rest of your day, everybody. We'll talk soon.